Hello and welcome to this Magellan Global Opportunities Fund update. My name is Mark Jordan from Magellan Investment Partners. Today I'm joined by Portfolio Manager Alan Pullen and Deputy Portfolio Manager Ryan Joyce. Welcome Al and welcome Ryan.
Thank you.
Al, perhaps start with you. Can you perhaps give us an update on what's happened in the past quarter and what were the main takeaways from your perspective?
Yeah, it's been a relatively strong quarter for markets. I think markets in Australian dollar terms are up around 6% for the quarter, which is a very solid return when you annualise that. And it's really been driven by the increasing focus on the AI thematic. That's been good for a number of positions within the portfolio, but it does raise some concerns because it's quite a narrow thematic at this point. And we've seen that more speculative activities start to creep into the market returns. Some of these kind of deals that OpenAI has been doing and NVIDIA has been doing with some of these second tier providers of data centers, for example, they're seeing some really strong returns in certain parts of the market. And starting to feel a little bit speculative in these areas of the market. So outside of that, some pretty solid data elsewhere going on. The GDP continues to do quite well in the US. We're seeing some increasing concerns about the labour market, but overall growth has been holding up fairly well. We've also had lower rates in the US, and that's been supportive for markets as well. So there's a few dynamics going on at the moment. The portfolio has delivered a solid return, but is starting to lag the market a little bit in this more speculative area. So things like some of the AI winners, Tesla and so on, which we really just can't get our heads around the valuation. We feel that's more speculative driven. But we are getting overall pretty solid returns from the likes of TSMC and so on. Elsewhere, the defensives are starting to lag a little bit within the market. And this is the nature of what happens as you get towards the tail end of these large bull markets and money's drawn into the more speculative, more exciting parts of the market. We're actually starting to see some pretty good opportunities in those defensive parts of the market. I think it's important that we maintain a balance across the portfolio.
Ryan, Alphabet has been a strong performer. Can you touch on your views on that stock?
Yeah, so Alphabet delivered around 40% returns over the last quarter. So very strong and certainly not something that we would expect to repeat itself or occur very often. But that was really driven by two main factors. The first factor was the favourable resolution of a court case in the US related to its search business. And the second was a positive reassessment by the market of its overall positioning in AI. So starting with the search case, Google has been found to be a monopoly in the US. And what everyone was waiting for was to see what remedies the court would pass down. And in particular, would it be able to continue to pay for distribution or placement on third-party browsers, including on Apple, which it currently pays over $20 billion a year to be that default search provider. And ultimately what transpired is the court delivered much more favourable ruling than expected for Google. It will be able to continue to pay for placement and be the default provider, just not on an exclusive basis within those contracts. And so what that means is we think it'll largely preserve the status quo versus incentivizing Apple to develop its own search engine or partner with competitors like Bing or potentially OpenAI. Now, ironically, one of the things the judge cited in delivering this more favourable ruling for Google was the disruption it faces from AI in its search business, which brings me to that second development, which is a reassessment of its positioning in AI. And rather than one specific factor driving that reassessment, there are a couple things. We saw it sign deals with OpenAI for cloud capacity and compute. We saw it sign deals with Meta for capacity and access to its models. We also saw it release a new AI image editor, which helped drive traffic to Gemini, its competitor to OpenAI. And really that saw the market reassess its positioning from, let's say, a clear loser to more net neutral, which we think is more appropriate. We have taken the position size down on the back of those strong moves, given we don't think you're being compensated for some of the downside risks that we do think still exist to the search business.
Al, semiconductors and AI remains very dynamic, a very dynamic sector. Are there any key developments from your perspective that are worth calling out?
Yeah, well, it has been a key driver of markets over the past quarter, as I touched on in the earlier question. And it really is quite interesting at the moment what's going on in that part of the sector. Now, we are really big believers in Gen AI and the opportunities that that has going forward. The question is, has that been overpriced by markets? Is the speculative activity just becoming a bit too excited by the opportunities here, given that they are real, they are significant, but once they become overly priced in, that can still lead to poor investment outcomes, particularly if it's in that more speculative part of the market, that it doesn't have strong economic moats that can really take advantage of those tailwinds that the Gen AI movement will provide to certain stocks going forward. So we've seen a lot more speculative activity start to creep into the market. We've seen these big deals that OpenAI has been doing with the likes of NVIDIA, with the likes of AMD as well, and Oracle. Now, OpenAI is a very exciting company, 850 million users. So they're scaling at an incredible rate, but they still have a very limited monetization of that user base at this point. So, they're writing a lot of checks that they can't cover at the moment, and that introduces more risk into the market. And these second-tier players who are kind of relying on that revenue to come down the track, when I build these data centers now, you get paid later, that's introducing elevated risk to that part of the market. So what we need to do is be careful that we're investing in those companies that have strong economic moats, that can really benefit from the tailwind that Gen AI is going to bring in terms of revenue, in terms of new markets, without facing those additional risks.
And perhaps a couple of stock examples that play to this theme, Al, one being ASML. Can you provide some comments on that?
Yeah, now ASML is a good example of one of those stocks that has an incredibly strong economic moat that is going to get a tailwind from this AI adoption going forward. Now, they've actually had a really strong quarter. There was some concern earlier in the year that TSMC was becoming so dominant as a customer that might curtail their monopoly kind of power that they have. They're effectively a monopoly provider of lithography equipment that is used to manufacture all the chips that, not just Gen AI will rely on, but anything that requires advanced compute in the future. So, they're an incredibly strong moaty company. But they were under a little bit of pressure earlier in the year, and we've seen some really interesting developments this quarter as Intel, another of their main customers, were facing a lot of financial pressure, still are to be honest, but they've had a government investment into Intel. They're starting to do deals with players like NVIDIA, and this has given the market a lot more confidence that Intel is going to be able to progress their advancements in terms of nodes. That's more advanced kind of lithography compute equipment will be required as they make higher and higher and more powerful chips. So they're nicely placed now to really take advantage of that Gen AI tailwind, the increase in compute intensity that we need over time, and all of it is going to be manufactured on these machines that ASML provides. So again, it's about utilizing that tailwind that we know is there, that we know is coming, but doing it from a company with a monopoly type position that can really take advantage of that tailwind and protect you from the downside should it be a bit slower than people expect.
Fantastic. And you mentioned TSMC there, or Taiwan Semiconductor, and Ryan, perhaps to you. Some comments on what they've been up to and the outlook for TSMC.
Mm-hmm. So no particular company-specific developments during the quarter, but as Alan talked about, we've had continued positive momentum on how much people are going to spend on AI, particularly OpenAI. It released its 5-year spending forecasts for revenue for CapEx, and the amount it spends or expects to spend has gone up dramatically. It expects to burn $115 billion of cash over the next 5 years. It expects to lose $45 billion of cash in 2028 alone, and a lot of that is going towards building AI infrastructure, buying AI chips. Most of those are going to come from TSMC with its near monopoly position at the leading edge. as Alan talked about, there's speculative elements creeping in here, but part of what has also happened over the last few months is it's reached these deals with NVIDIA, with Oracle, with Broadcom that do have a lot of cash flow and will support that investment, at least in the near term. There is uncertainty, regarding the return on those investment in those chips in the medium term, and so we think you do want to remain in those quality players where you have conviction in the medium to long term benefits they will get from AI, but these deals have helped underwrite those investments in the near term as well and supported TSMC.
Given the concentrated high conviction nature of the fund, how do you think about trimming winners versus letting them run?
Yeah, no, that's a good question. Now, we've got a really disciplined process here with the Global Opportunities Fund. We actually explicitly target a position size. And that position size is determined by the company's quality, its intrinsic value support, and the risk that it faces. Now, it can be very tempting when you're seeing a winner, go up. That feels good. And a lot of people are tempted to let that run. But we remain really disciplined around our process. We actually have a sit down and we have a discussion on, is this running purely for a change in narrative? In which case, our original position sizing based on those 3 quantitative factors is probably appropriate, and we trim accordingly. This naturally sees us leaning against those winners that might be becoming a little less supported by valuation and leaning into those high quality companies that are maybe a little bit more out of favor at the moment. But we do assess if something has changed. If something has changed, genuinely changed, increasing the quality, supporting the earnings and intrinsic valuation, then we will adjust the position size accordingly. But we don't let the market dictate this portfolio. We dictate it based on the underlying principles of what we're trying to achieve for clients.
Thanks, Al. Now, I suppose the million-dollar question, what can investors expect looking forward from markets, from the portfolio? How are you positioning the portfolio currently?
Look, it's a good question. I mean, it's been a fantastic few years for investors. The Opportunities Fund's delivered more than 20% return kind of over the past 3 years. These kind of returns shouldn't be expected going forward. That is not what the market kind of can deliver over the long term. So we should expect, given starting valuations at more elevated levels now, that returns are more modest. Now, in terms of the key risks that are out there, the macro looks okay. There are risks around the labour market, but on the other hand, we've got lower interest rates, which are somewhat supportive. So kind of balanced there. Inflation, we do believe that the market, the Fed Reserve will look through the impact of tariffs and that inflation will not become embedded in the US. So that's another risk that we're monitoring, but actually kind of looks okay. The third key risk I think we've got to pay attention to these days is the strength of US institutions. They have been challenged by the Trump administration and some of the things he's doing in terms of cracking down on the Fed and pushing for lower rates. But so far, those institutions are holding. So far, he's working with Congress. The Supreme Court is, challenging some of these executive orders if they're not to the letter of the law. So far, that US institutional strength is holding. It's bending, but it's holding. So we are monitoring these kind of risks pretty closely. But base case is that the market continues to grind up. Returns will be lower than they have been the last few years. That's just natural given the starting elevation. But we don't see a trigger for a major reversal at this point. The risks are there, and given elevations are high, if something does go wrong, certainly there's a potential drawdown in the markets. So we're monitoring that very closely. What's happening in AI, of course, is the speculative area there becoming extreme and subject to reversal? So there are a few things we're keeping an eye out for. And given those risks, we are positioning the portfolio somewhat defensively. We're still seeing great opportunities in the IT sector, I should say. Microsoft is fine, Amazon is fine, TSMC we've talked about. But overall, we're actually seeing some really good opportunities in that defensive part of the market as well. In fact, interestingly, double-digit returns on some of those defensive stocks with very low risks. We think that's going to be more than adequate for investors kind of over the next 3 years. Of course, we're thinking the long term here. So we are starting to lean into some of those opportunities there.
Thanks, Alan, and thanks, Ryan. And thank you for watching. If you'd like more information on the Magellan Global Opportunities Fund, please contact Magellan Investment Partners. As always, feel free to share this video with clients or colleagues. Thank you.